I'm going to go ahead and record this. Speaker is Kip Wallen, Senior Director of Thought Leadership at SRS Acquiom. And today the discussion is going to be about latest trends in M&A deal terms, including purchase price adjustments, earnouts, indemnifications. As you know, SRS has been doing these sorts of programs or this sort of survey for as long as I can remember. And they do this annually from, it looks like thousands of private target deals. And they come out with a PowerPoint and a report and a summary that is really useful in understanding what the trends are and is a good place to start. We'll put it that way as to where market is. So with that, Kip, if you're ready, I've allowed you to share your screen if you have something you want to share. There we go.
All right, great. Well, thank you so much, Roger. And it's great to be with all of you. Yeah, unfortunately, I was in the Bay Area just a couple weeks ago, but the timing didn't quite work out. So sorry, it has to be virtual. But yeah, I agree with you. I kind of look forward to those in-person meetings, and they're starting to happen a little bit more and more. So, but anyway, any way we can get together is always great, and happy to share our latest deal term study with all of you. So one thing I'll say before I get started, I really do like it when these sort of presentations can be as interactive as possible. So feel free to just unmute yourself and interrupt me with any questions that you have as we're going through the data. I really want it to be something that is meaningful for you and you get the most out of it. So be sure to, we can drill in on the data that you have more questions on, or if you want to, just give a little deeper dive, just let me know, just unmute yourself. I'll also reserve just a little bit of time at the end for questions as well. So just a little bit about me. My background is as an M&A attorney. So I practice M&A out of a Denver firm for many, many years, doing mostly sell side, sort of on the lower end of the middle market. I joined SRS Acquiom about 5 years ago, and a little over a year ago took over their thought leadership practice. So now all the data studies and sort of resources we put out for M&A practitioners, I get to work on all those. So it's been a pretty fun new role for me, although I really can't call it new anymore since it's been over a year at this point. For those of you who are looking, just a little bit of background about SRS Acquiom. If you are working on a private M&A deal and you're looking for a professional shareholder rep or an escrow agent or a paying agent, we've got an incredible business development team. So on the West Coast, based out of the Bay Area, we've got Krista Fancher and Janelle King. Their contact information is right there. In the central region of the country in Canada, we've got Eric Martin. And then Troy Hebert and Amanda Jackson on our East Coast and European regions as well. So if you ever have any questions about SRS Acquiom products, this is your team to reach out to. So we offer a suite of services that help make your M&A deal run just a little bit more smoother and more efficient. That's really our goal in life, is to make these deals happen and happen efficiently for the deal parties. So we started about 15 years ago as the first firm to offer professional shareholder representative services. So shareholder rep is the post-closing representative of those former security holders of the target. So once buyer comes in, buys the target company in the M&A transaction, and management and the lawyer engagements, all that now belongs to buyer because it's a wholly owned subsidiary. We come in as representing those shareholders that probably got paid most of the consideration at closing, but there might be those ongoing post-closing matters, right? Like a purchase price adjustment, maybe there's an earnout on the deal. If there are indemnification claims that come up, that's where we would step in and really help facilitate those post-closing mechanics. So always working with the sell side. So we usually set up 2 or 3 folks from that group of former security holders to be our advisory committee. So always running things by them, taking direction, but really just handling all the sort of administrative and all the stuff that's a bit of a hassle post-closing. About 10 years ago, we added the Acquiom side of the business, which is our financial services company. So now we also do payments and escrow for these M&A deals. The payments platform is pretty nifty. We pioneered bringing that entire process online. So instead of on these merger deals having to mail out, these thick letter of transmittals, everyone fills them out and mails them back, we brought that whole process online, which just adds a whole lot of convenience and security functionality to the process. Also can do enhanced stockholder solicitation with that platform. Last year, we added a virtual data room. So just continuing to add more technology offerings to help you on your M&A deals. And then we also offer loan agency. So if you have syndicated or bilateral loans, we have a really great team on the loan agency side of things as well. Just because it's been in the news a lot of people are talking about sort of the banking sector and what's happening there. Just to reaffirm that when we act as the escrow agent, we do use very secure big banks that actually hold the deposits. So while we're the escrow agent and we sort of provide the customer service levels, the money is actually being held right at HSBC, right, which is a $3 trillion bank, global bank. We also work with Citizens and Truist. So we actually have on quite a few deals that had already closed prior to sort of when Silicon Valley Bank and First Republic, those started to happen. We did get some inquiries on these deals where buyers and the former security holders were kind of wondering, hey, we've got a $10 million escrow sitting in this regional bank, is it okay? So not, given what was going on in the banking sector, not surprisingly, we got those inquiries. We're kind of able to help our clients there to make them feel a little bit more comfortable. Hopefully we're through the worst of sort of the banking turmoil. These are just some high-level stats about the company. I really like this slide because it's a great jumping off point to talk about the data. So we've been engaged in over 7,300 deals, either as the professional shareholder rep or the escrow agent or paying agent or some combination of those services. And about half of those are deals where we were the shareholder rep. And in that role, we get all the closing documents. So we're able to see the purchase agreement, a lot of those ancillary agreements, and that's what allows us to go in and pull all this really great data and provide sort of an aggregate view of what's going on in the market with deal terms. Here's just a few examples of some of the deals that are included in the data set that relates to the data that we're going to be talking about today. So just a really nice representation across the market, some really big deals, also quite a few deals in that lower middle market area as well. So for our agenda today, covered SRS Acquiom a little bit. I'll give you a few pointers about kind of how you can use this data and these data studies generally. And then we'll get into the data points. So starting with these pre-closing matters, what goes into the deal economics. So looking at things like are parties using buyer equity to fund part of the merger or all of the merger consideration? And are they structuring these deals with earnouts? And what do those earnout structures look like? Then we'll transition to some of those post-closing matters. So really getting into deal terms around purchase price adjustments, sometimes referred to as working capital adjustments, and indemnification matters as well. So again, feel free to interrupt me, ask questions as we go through the data. Since we have a limited amount of time, I've just sort of selected the greatest hits, and we'll kind of hit on those high level, but happy to dive in and answer questions as we go along. So first, just a little bit about the data. Overall, we provide about 5 years of data just so you can kind of do some year-over-year comparison. So that's a total of over 2,100 deals included in our data set. These are all private target transactions, and the vast majority of them are not publicly disclosed. So there are some other data studies out there that I think, they're very complementary to ours that are pulling from slightly different data sets. So the American Bar Association, for example, theirs is pulling from deals where it was a public company buyer and the deal was material enough to that buyer that they disclosed it via the SEC Edgar website, right? Whereas our deals, most of them, 95% or so, are not publicly disclosed deals. So if you're working on a private deal and it's another private buyer, or maybe it's a public buyer, but it's a small enough deal that it's not material to that buyer, they wouldn't have to disclose it. Our data set's gonna be great for that. We have a really nice representation of tech deals. About a third of our deals are technology target company deals. About 40% of our deals have a private equity buyer, either a fund directly making an investment or a PE-backed portfolio company doing a bolt-on transaction. So a nice representation of private equity and private equity-backed buyers. About 40% of the deals in our data set last year had reps and warranties insurance. So reps and warranties insurance is that product where you kind of shift the liability for those post-closing breaches, post-closing claims for breaches of reps and warranties kind of from the sellers directly to an insurance policy. And so because you're sort of shifting that indemnification risk, that plays a big part in how some of these deal terms play out on those deals. RWI usage was down a little bit last year. It had been 44% in 2021. And even on smaller deals, so like deals that are 50 million or less, which is sort of like an informal cutoff point for where people might think like you would use RWI on deals bigger than that, maybe not as often on smaller deals. That is true. And 50 million or smaller deals, about 20% of those had RWI in our data set. And most of those are going to fall sort of between that 20 and 50 million range. Deals 20 million or less very rarely have RWI. And the reason for that is not that it's not necessarily a good product for that particular deal. It's just usually at that point, the cost of coverage is a little prohibitive because there's usually a minimum amount of coverage required. Just a quick shout out. We do have a free tool, data tool available on our website called Market Standard. You can register for free. It's basically all of our deal terms data, but it allows you to filter it by like buyer type or deal size. So you can kind of get the data tailored a little bit more to your specific deal, which again is always helpful. So anytime you're looking at these data studies, important to remember that they're really helpful for sort of ballpark ranges, kind of giving an idea of what the average and the medians are for the market. Like Roger said, they're a good place to start, but every deal is unique, and that's what keeps us in business as M&A practitioners, as advisors and lawyers, right? So just because we have a particular data point that we're presenting in our study doesn't always mean that's where it's going to land for your deal. So let's get into some of the data, starting again with a little bit of background about what's in our data set. These are buyer types. So our top teal category, those are US public. Then that orange category are private equity making direct acquisitions or investments. The yellow category, those are US private. And actually starting this year, we're breaking down that category between PE-backed portfolio companies and then sort of non-PE-backed or sort of other private companies. So you can see when you add that 14% orange and that 26 sort of middle yellow shading, that's where you get that 40% of deals that have a PE influence. And then that gray category, those are non-US based buyers. So we did see a fair amount of inbound or for cross-border M&A last year, private M&A, but down from previous years. And that actually went both ways. So there's a lot of commentary out there about outbound US investment, not quite as active last year. So that teal category, that US public category on top, you can see a little bit of a pullback from 2021 numbers. And there's going to be a recurring theme as we go through all this data that 2021 was really an outlier year. I mean, it just was a banner year for M&A, just record-breaking deal volume, record-breaking valuations. The pace at which deals were happening in 2021 was just phenomenal. I mean, it was just an incredible year. So a lot of our 2022 data will kind of be looking at it compared to 21, but 21 was such an outlier year that we really kind of have to look at longer-term trends. And so even though there was a bit of a pullback from strategic buyers compared to 2021, still a healthy market. I think buyers being a little bit more opportunistic last year than they were in 21, not nearly as much competition among buyers last year. Those deals that were happening by strategics, even though sort of financial buyers, private equity buyers, maybe took a little bit bigger chunk of the market on the buy side last year, those strategics that were active last year, again, being opportunistic, maybe focusing on smaller deals to kind of fly under the radar, maybe avoiding some regulatory scrutiny because we've seen regulators be a little bit more active this past year or so. So really interesting dynamics around buyer types and then transaction values. This next slide, you can see valuations were down in 2022, right? We're all sort of familiar with that. Lots of commentary out there about where valuations are. It's not only are valuations down, but it's also just difficult to raise capital at the moment, which is sort of putting further pressure on valuations. Compared to 2021, especially, it looks like a lot of, the smaller deal categories, the black, the grays there, increased quite a bit. But again, 21 was just that outlier year. So long-term trends for valuations generally still pretty healthy for target companies. So I think there probably are some targets out there, and you might be hearing this from your clients about, yeah, we're going to wait till we kind of see 2021 valuations again. I don't know if we will see those valuations. I mean, they were very, record-setting valuations that year. So I think, valuations are still relatively strong. We're not seeing a ton of distressed M&A or even sort of distressed adjacent M&A, although we do see some of those deals, and we did see some last year as well. But overall, I think, the deals that are happening, the valuations for these targets, not what they would have gotten in 21, but still long-term, looking at several years of data, pretty healthy valuations. So kind of in that middle market, the 25 million to 750 million range, you can see it in a slightly larger percentage in 2021 than in 2022, and a pretty dramatic increase in these smaller deals, these 25 million or smaller deals last year. So again, strategic sort of, looking at smaller deals, being more opportunistic, and financial buyers being a little bit more active, kind of looking for those opportunistic investments. For the structure of these deals, whether it's a stock purchase or an asset purchase or a merger, this is one area where I like to point out, a caveat with our data set is that we do have an underrepresentation of asset deals. So if you're working on an asset deal and you're looking at our data, just keep that in mind that it's a very small percent of the overall data set, but a really nice representation of stock purchases and mergers. One thing that was interesting in 2022 is for private equity or those financial buyers, slightly more likely to use a merger structure. For public buyers or those on the strategic side, a little bit more likely to use a stock purchase. I mean, not varying too much from the overall all deals data for 2022, which is the bar there right next to our red box. But just sort of interesting that I think, again, deal parties just being opportunistic and trying to get the deals done, the transaction structure often being driven by tax considerations and getting shareholder approval. So it may just be indicative of what the environment looked like last year. Okay, so getting into some of our sort of more meaty deal terms, starting with deal closing consideration trends. How are buyers paying for these deals? Our top category, that teal category there, those are combo deals where the buyer is using both their own stock and cash. The orange sliver, those are all stock deals. And then the yellow category being all cash deals. So you can see cash is still king, 3/4 of deals using cash. But over the long term, there is an increasing trend of deal parties, of buyers using buyer equity to fund these transactions. So in 2021, a pretty noted uptick. Not surprised. I mean, 2021, not only were the private markets setting records, but the public markets did really well in 21 as well. Buyers essentially being able to print their own money with their equity. So of course they were using equity as part of their merger consideration, but still a pretty strong usage of buyer equity in 2022, particularly in the fourth quarter. So in the fourth quarter of last year, we didn't see sort of that dramatic increase in deal volume that we typically see in a fourth quarter of the year. But the deals that were happening, a lot of them using buyer equity, and it pulled that teal category up from like maybe closer to 16 or 18% for the first 3 quarters of the year, all the way up to 23% for the entire year average. New this year, we're also tracking deals that are what we would typically call all cash, but they have a management rollover component. We're starting to track those with 2022 deals going forward. So 20% of deals last year having that management rollover component. So that's when like a subset of the security holders of the target, quite often the management team, are offered the ability to roll over their existing stock for stock in the new entity, the post-closing entity. And oftentimes the buyer does that as a way to sort of align interests, particularly if that management company is going to continue to run the business post-closing. All right, earnouts. Always love talking about earnouts. These are the most contested post-closing mechanics. So always good to talk about the deal terms that get negotiated going into closing. And I've got some insights of sort of what happens post-closing. So a little bit of an uptick in the prevalence or frequency of earnouts last year. For our earnouts data, we do pull out life sciences deals from this data set, just because life sciences deals are very different when it comes to earnouts. About 2/3 of life sciences deals have an earnout, compared to 21% of all the other deal types. So when I say life sciences deals, I mean the target company was a life sciences company. But interestingly, on the other side of things, deals that have a technology target actually pull this percentage down. So if you have a tech target deal, about 14% of those deals had an earnout. So only about 2/3 the prevalence of all the other kinds of deals. And in fact, if you pull the tech deals out of that 21% figure, it actually goes up to about 26%. So if you're working on a non-life sciences, non-technology deal, about 1 in 4 of those are going to have an earnout. And then new this year, we're tracking whether it's just one earnout milestone or if there are multiple milestones or sort of achievement triggers for the earnout structure. You can see a majority of the time there are multiple triggers. So about 3 in 5 deals having more than one milestone or metric. Here's kind of a breakdown of what those metrics look like. Our teal bars, those are 2022 deals. So you can see a little bit less prevalence of revenue metrics or those top line financial metrics, and more deals with the earnings or EBITDA or sort of that midline financial metric. Buyers tend to like earnings or EBITDA metrics a little bit better, arguing that those are a better indication of the performance of the company versus a top line revenue metric. Sellers tend to prefer revenue metrics because there's not as much gap interpretation that goes into those. They're a little bit, arguably a little bit more streamlined in calculating, although that's not always the case with revenue recognition under gap interpretation. So not surprising, we're going to see there are some subtle or even not so subtle buyer favorable trends in the 2022 data as we go through these data points. One that I thought was interesting though is that bottom category for other deals, or sorry, for other types of metrics. So in 2020 and 2021, those yellow and orange bars, we saw a pretty noted uptick in these very customized, like bespoke metrics for earnouts. So like one example I like to give is on tech deals, those deals that do have an earnout, maybe tying the earnout to like quality of users, right? Like this came up on the Twitter deal with Elon Musk, right? He tried to get out of the deal saying, hey, you don't have as many users as you said you did because there's so many of these that are bots and not humans. We see similar type of metrics, those sort of very deal specific metrics on earnouts as well. But a pretty noted drop off, you can see down to only 22% in 2022 deals. So perhaps indicative of buyer maybe not loving those sort of very customized metrics and preferring more of an EBITDA financial metric. For the size of these earnouts, this percentage is calculated by taking the maximum potential earnout amount and dividing it by whatever was paid at closing. So like 31% would mean there was a 31% potential earnout, 31% of the closing payment. So before the pandemic, right, we had seen the usage of earnouts and the size of these earnouts go down pretty dramatically. Of course, the pandemic hits and sort of changes that story. But interestingly, even though we pretty much navigated past the pandemic in terms of sort of how it is affecting deals or if it's having a big impact on deal terms, although the drop off, maybe not quite as pronounced as I would have expected for the size of these earnouts. So sort of interesting, one that we'll definitely continue to watch. And then one last note on earnouts, we also track operations covenants. So is the buyer obligated to sort of operate the target company's business a certain way post-closing in order to achieve that earnout? On the far left bar there, the covenant is to run the business in accordance with the seller's past practice. So that's a it's a seller favorable covenant, but not quite as restrictive as the next one over, where there's a covenant to run the business to maximize earnout payments. You can see a pretty difference in how often those are used. That 23% of running the business in accordance with past practice, that actually went up a little bit. It was 18% for 2021 deals. And then as you can see here, and then it kind of came up a little bit. So I think that's probably indicative of seeing more smaller deals last year than the year prior, and a lot more financial buyers sort of in the mix. So a little bit more common for the management team of those companies to stay on board and continue to run the business. And when you've got the existing management team staying in place, right, it's a lot easier for the buyer to agree to that covenant because the same people are running the business. So of course they're going to use past practices. The covenant to maximize earnouts, though, that was virtually none last year. I mean, we're being generous, rounding it up to 1%. It was literally one deal in our data set, whereas it had been 7% the year prior. I think I might be losing the battery on my, I'm just going to pull my thumbs out here. Let me just make sure my audio is okay. All right, hopefully you're still able to hear me. All right, moving on to purchase price adjustments. Let's see, we got about 15 minutes left, so I'm gonna pick up the pace a little bit, but don't let my fast talking stop you from asking any questions if you have them. So purchase price adjustments, sometimes referred to as working capital adjustments, nearly ubiquitous on private M&A deals. If you're working on one of these deals, you're probably going to see a purchase price adjustment. And really great that we're seeing the vast majority of these, that yellow category, be a separate mechanism being negotiated and put in the agreement for these purchase price adjustments, right? Because these really aren't indemnification claims, right? They do happen post-closing, but it's an accounting true-up mechanism. It's not really an indemnification claim. So having its own provision can really be beneficial in making sure these things run smoothly. And this quite often is probably going to be the first sort of formal interaction that buyers and sellers are going to have post-closing, right? These PPAs often play out maybe 60 or 90 days post-closing, where the parties are going back with final accounting numbers to determine, did the company, the target company, have enough operating cash on hand at the time of closing? So because this is kind of that first formal interaction, it can set the tone for how the parties work together generally post-closing. And that can be really important, particularly if you've got you know, an earnout on the deal, and you know, that might last several years. If there are going to be indemnification claims that come up, right? If you have a smooth PPA process and the parties sort of have a really good interaction with this mechanism, that just sets you up for success for positive interactions for those other matters as well. One way to sort of get in front of that is to work with the buyer. So when you're on the estimate for the calculations that are done leading up to closing. So because the target company doesn't know final accounting numbers at closing, right? They prepare an estimate, usually a couple of days before closing. We started tracking this year if the buyer has a contractual right to review those estimates. And this 11% figure, that's actually a lot lower than I was expecting it to be. And I think in practice, it does happen a lot more than that. And that we think that's a best practice. If the parties sort of come together and work together on the estimate process right at the closing, that basically sets them up for success when they have to do the final calculations with final numbers, you know, 60, 90 days later. So even though only 11% of buyers have a contractual right to sort of participate in that estimate, I think it happens a lot more often than that, and that's a great practice. It can help make the final calculations run a lot smoother. Thinking about the accounting methodology and what financial metrics go into the calculation, also really important, and can affect how these things play out. So working capital, right? So these PPAs, sometimes called working capital adjustments. Working capital is really what we're getting at. But the general accounting definition, right, as most of us know, is current assets minus current liabilities. And under GAAP accounting, that pulls in all sorts of financial metrics that sort of get beyond what was the actual like cash position of the target company. So a lot of times we'll see parties taking that customized approach and identifying exactly which financial metrics they really care about for this PPA. So on the left here, you can see 82% of the time parties pulling out tax-related items, like maybe a deferred tax asset, something like that. So again, parties that take the time to customize these provisions, really think through how it'll play out post-closing, just helps set the parties up for success. Similarly with accounting methodology, GAAP consistent with past practices remains the prevailing practice, but that's sort of been coming down. That's that yellow category on the right. If you are going to use the GAAP consistent with past practices, we always suggest putting like just a few additional words there, because what happens, because past practices means the past practices of the target. Well, what happens when buyer's interpretation of GAAP doesn't jive or agree with how the target company applied GAAP? So having some additional words there about how to resolve those differences can go a long, long way. Or an approach that we're seeing gain a lot of popularity is to use a specified worksheet that lays out exactly which financial metrics go into the calculation. You use that for both the estimate and the final calculations post-closing. Often it's attached as an exhibit to the agreement itself. And you can see we just started tracking in 2022 this new category, that's that 26%. So 1 in 4 deals using this worksheet approach. Our post-closing team loves to see it. It takes a lot of the guesswork and sort of ambiguity out around GAAP interpretation and just streamlines the process. One trend, and we'll talk a little bit about this too, is I'll get to, we have a really great slide on deal escrows, but we're seeing more special escrows across the board on these private M&A transactions, including special escrows for the PPA specifically. So here you can see the yellow bars going up year over year, but not only are more deals using a separate escrow for the PPA, but the size of these escrows are also ticking up, which I think is a good trend, because when a buyer thinks they're owed an amount under the adjustment, on average, their initial claim is closer to 1% of the transaction value. So you can see if the median escrow size is 0.88% of the transaction value, that escrow can get eaten up pretty quickly, with the buyer coming in with a 1% claim. Now, oftentimes that 1% does get negotiated down. So that's sort of an important takeaway as well. On the next slide, I actually have data from our claim study that came out in September. And on the left here, you can see 88% of the time when there is a purchase price adjustment on these deals, an adjustment actually results. There actually is money paid one way or the other. A little bit more likely to go to the buyer. So that yellow category, 48% of the time, it's a buyer favorable claim. 40% of the time, though, it's a seller surplus, meaning the sellers are getting some money back because the company had more working capital than it really needed at closing. Plus, if there was that PPA escrow, the sellers are also going to get that escrow amount back. And so 40% of the time, that's a significant chunk of deals. So if you're working on a deal on your sell side, these PPAs, they've gained a lot of importance for sell side, in the last 5 years or so. Before that, a lot of these were really one-way mechanisms where they really could only benefit the buyer. And if there was an adjustment, it was going to the buyer. But now you can see it's nearly equal that sometimes, the sellers get money out of this. And in some cases, it's real money that they might be leaving on the table. So just a few additional stats. I'm actually going to skip over those just to keep an eye on the time here since we only have a few minutes left. Moving into some of our indemnification deal terms, I just picked a few that I thought were really interesting that I wanted to point out. First are deals that are being structured as a no survival or a walkaway deal, sometimes referred to as like a public style deal, right? Because when you have a public company being acquired, right, there usually is not post-closing indemnification, right? Because those are publicly traded shares, and sort of once you cash them out, right, you can't really hold them accountable. On private M&A, of course, you can hold sellers accountable post-closing. But you can see some deals, even though it's a private deal, the parties will still structure it as a no survival. And what that really means is that not all the reps and warranties are going to survive closing. So like there's probably a bunch of reps and warranties that the seller makes at closing. Once the deal closes, if it's a no survival deal, the seller, if there's any breaches of those reps and warranties, the seller's not going to be on the hook. Although there may still be certain things carved out. So even though we call it a no survival deal, there may be certain kind of one-off things or noted like things that are expressed in the agreement that the sell side may still be on the hook for. And this is one area where RWI, that reps and warranties insurance, has a big impact on deal terms. And of course, it makes a lot of sense, right? If the buyer has recourse against an insurance policy, they're probably much more likely to let the sellers directly off the hook. And that's exactly what we see when we look at the data. So here are our deals across the last 4 years. Those deals that do not have RWI, you can see, right around 12% of deals, a little bit of an uptick in 2021 because it was a seller favorable market that year. But generally, vast majority of deals being structured with full survival, where those sellers are going to be on the hook. But when you look at those deals that do have that reps and warranties insurance, completely different story. And it's actually gotten to the point now where 50% of deals that have RWI being structured as a walkaway for the sellers. So really big impact on deal terms that we see sometimes when reps and warranties insurance is present. For those deals that do have survival, the median, looking at our table at the right here, back up to 15-month median survival period. It dipped down to a 12-month median in 21, again, just because it was such a seller favorable year. One thing I will point out is we are seeing that sort of less than 12 months category or that 12 to 18 months category, kind of year over year, seeing more deals fall into those categories. Because again, parties are taking really customized approach to these deal terms more and more. We continue to see that trend. And so maybe rather than just tying it to like a straight 12-month period from the closing date, maybe they're tying the survival period to to a reporting period. So the deal closes in February, maybe the survival is 12/31 of that year rather than a full 12 months or something like that. One really interesting, I'll just mention really quickly because I know we only have a couple minutes left, on materiality scrapes. I usually don't talk about materiality scrapes because they're just not that interesting to talk about. And honestly, we don't spend a whole lot of time fighting about materiality scrapes post-closing when we're working on these indemnification claims. But there was something interesting in the data this year that I wanted to point out. So for like 2020, 2021, sort of indicative, similar to years prior to that, about 10% of deals not including a materiality scrape. So the materiality scrape is like when the seller is making all those reps and warranties and they say, we're not violating anyone else's IP, or, we don't have any, we're not like dumping hazardous materials in the environment. But if you have materiality qualifiers, right? Like, we're not materially breaching anyone else's IP, right? If you have those qualifiers in there, a materiality scrape would actually kind of knock those qualifiers out, either for determining whether there was a breach, the damages or the amount of damages for that breach, or both, which would be referred to as a double materiality scrape. So we can further break down our yellow category here by the type, whether it's a single or double scrape. But it's more that gray category in 2022, deals that don't have the scrape included, increasing almost 50%. I wonder what was going on there. It turns out, not surprising, our culprit is RWI. So I'm going to break down our chart here a little bit. Again, starting with those deals that don't have RWI, you can see right around 10%, that gray category on the right. So nothing too exciting year over year there. But when you look at deals with that reps and warranties insurance, something interesting going on in 2022 with nearly double the amount of deals not having a scrape. And what I think is going on here is when a deal has an RWI, like an insurance policy in place, that policy is governed by the policy documents, not necessarily what's in the definitive agreement, like the actual purchase agreement or merger agreement. And this data is tracking what's in that definitive agreement. So the RWI policies, they pretty much all default to a double materiality scrape. Like, for whatever reason, insurance companies have just gotten comfortable with that. So the buyer knows they're going to get the double scrape if they're going against the insurance policy. And I think what's happening here is the sellers in the agreement, the actual definitive agreement, are pushing back and saying, hey, you get the double materiality scrape when you go against the insurance. But if you're coming after us directly, the sellers directly, you don't get the scrape. So that's why I think we're seeing sort of a discrepancy here of what's in the merger agreement versus what's in the RWI policy. So again, just an interesting impact that we're seeing from RWI. And then I'll end it on this slide since I'm almost out of time. This is a really nice slide where we're adding some new data this year around special escrows. And I think this data is particularly helpful when setting expectations with deal parties about, if you're using a deal that has that reps and warranties insurance, or even without that insurance product, how likely are you going to have to escrow funds, and how much are you going to have to set aside? Like, particularly if you're on the sell side, you're going to want to know that. So looking at our table here, our chart, on the far left, that's just how many deals in general have at least some escrowed or held back amount. And it's over 90% of deals. Even when you break it down, RWI versus non-RWI, right? Just about all of these deals having some amount of money being held in escrow. And even if you look at deals that have 2 or more escrows, it's over half of the deals. That's our next set of bars there. So again, we're seeing more and more of these parties using these bespoke approaches to the indemnification mechanics and how they're structuring the escrows. And that was accelerated even more in 2022 because buyers were taking more time with due diligence, really identifying any kind of potential issues. And if they did see any of those, yellow or red flags during the due diligence, using escrow structures to sort of account for that and make sure that there was enough security for the buyer to move forward and close the deal. So again, just really bespoke, customized indemnification provisions tied to the particulars of the deal. So the last thing I just want to point out, that last set of bars there sort of in the middle, those are other special escrows. A third of deals including special escrows. So, maybe for tax matters, employee retention matters, something like that. 1 in 3 deals having an escrow beyond a PPA escrow that we were talking about earlier, or that general indemnity escrow. And then I know I'm out of time, but I'll make my last point really quickly. So again, kind of getting at that expectations of the deal parties, like particularly using deals with RWI as an example, on the bottom, that's the median size of just the indemnity escrow, 0.5% of the transaction value. That's been the median for RWI deals for many years. And a lot of clients think like, oh, I have RWI, I'm only gonna have to escrow 0.5% of the merger consideration. But the top table actually shows when you factor in all those additional special escrows and you add them all together, how much total is actually being set aside in escrows. You can see it's 5 times the amount, or 2.5% of the transaction value. So again, if you've got those clients with certain expectations, hopefully this data can sort of help understand that buyers may come in and ask for these additional escrow amounts. So with that, I know I didn't get quite through everything, and I talked really quickly through a lot of data at you, but I'm happy to pause here and take any questions. Stick around for a few minutes for those of you who have time.
Okay, thank you very much, Kip. I'm going to stop the recording.